Hello, fellow Arbab. It's time to boss your money. Today, we are doing something I've been putting off for a while, a complete transparent breakdown of my investment portfolio.
Okay, it's happening. Everybody stay calm.
No gatekeeping, no secret strategy for exclusive members only, just the raw numbers, the strategy, the logic, and yes, even some of the mistakes I might be making. Now, before we dive in, let me tell you why this video matters. As Warren Buffett once said, risk comes from not knowing what you're doing. And I think as a community of NRIs in the UAE, we're all trying to figure this out together. So consider this my contribution to the collective knowledge. I know you let me know if I've done something controversial. For context, I'm 35, been investing for over a decade, but this specific allocation is relatively new. This works for my risk tolerance and my timeline. Your mileage may vary, and this is not financial advice. I'm not a SEBI registered advisor. I'm not a CFP. I'm just a guy with a spreadsheet on YouTube with opinions. Got it? Good. Let's get into it. BT dubs, if you are the type who gets bored easily, I've added timestamps below, so feel free to skip around. But if you stick through the whole thing, I promise you'll understand exactly how to think about portfolio construction so that you know how to create your own. Alright, so let me show you the forest before we examine the trees. My portfolio is divided into three main buckets. Global ETFs, which is about 45.53% of my portfolio. This is my growth engine. This is my sleep well at night diversified exposure to the world's best companies. Then I have my Indian mutual funds, which is about 6% of my portfolio. My tactical bet on India's growth story, small but meaningful. And then I have my cash-like investments, which is about 48.42% of my portfolio. And here's where eyebrows might rise. Nearly half of my portfolio is what I call liquid fuel. This is split between national bonds at 12% and Mashreq Neo at about 36.31%. Now I can already hear some of you screaming at your screens, dude, why is there 36% sitting in a savings account? And we'll get to that. But first, let me explain my philosophy. See, I'm not trying to maximize returns. I'm trying to optimize for opportunity and stability. That Mashreq Neo allocation, that's my opportunistic capital. It's for market crashes, for real estate down payments, and for holy crap, this deal is too good to pass up moments. Think of it as dry powder, not dead money. You know what they say, don't put all your eggs in one basket. Well, I've got eggs in 6 different baskets. As Charlie Munger once said, the big money is not in the buying or selling, but in the waiting. And having liquidity means I can act when others can't. Okay, philosophy lesson over. Here's a little bit of what we're going to be covering in this video. First, we're going to talk about a deep dive into each ETF holding that I have. Then I'm going to talk about the overlap question, am I duplicating positions? Then we're going to look at quick ETF explainer if you don't know what an ETF is, which is very short. My India bet and why only 6%, and then the controversial cash allocation. Then we look at when this strategy makes sense. Spoiler alert, it's not for everyone. Finally, we'll talk about the risks and closing thoughts. All right, let's go. My ETF portfolio represents 45% of my total assets, but internally it's allocated across 6 different positions. Some of you might be asking, 6 ETFs? Isn't that overkill? Maybe, but there's a method to my madness. Think of this like building a house. You need a strong foundation, load-bearing walls, and some architectural flair. My foundation, the S&P 500 through CSPX, which is the iShares Core S&P 500 ETF. CSPX is about 17.68% of my ETF portfolio, and it forms about 8% of my entire portfolio allocation. This is the GOAT. The iShares Core S&P 500 UCIT ETF gives me exposure to 500 of America's largest companies. The top 5 holdings in CSPX are Nvidia, Microsoft, Apple, Amazon, and Broadcom. This is similar to the VOO ETF from Vanguard, but that is US domiciled, whereas CSPX is an Irish domiciled ETF. Why this specific ETF? 3 reasons. Cost, it has an expense ratio of just 0.07% annually. That's dirt cheap. For every 10,000 dirhams I invest, I'm paying just 7 dirhams per year in fees. And it's UCITS compliant. For us in UAE, this matters. These are European domicile ETFs that follow strict regulatory standards. The second benefit is that it's accumulating. The dividends get automatically reinvested, no hassle, no manual work, compound interest on autopilot. The expected return, I'm modeling 10% CAGR, conservative considering historical averages. In fact, all of my projected ROIs in this video are on the conservative side because I'd rather be pleasantly surprised than disappointed. The next one that I have in my portfolio is XNAS, which is X-Trackers NASDAQ 100. This forms 20% of my ETF portfolio and about 9% of my overall portfolio. Now we're adding some spice. This is my largest single ETF position at 20% of the ETF bucket. But wait, you might be wondering, isn't there an overlap with the S&P 500 CSPX ETF? Yes, absolutely there is. And we'll talk about that in detail later. But here's why I'm okay with it. The NASDAQ 100 is tech heavy. It's growth focused and has historically outperformed. The top 5 holdings in XNAS are Nvidia, Microsoft, Apple, Broadcom, and Amazon, the future of innovation. The expense ratio here is 0.2%, still incredibly cheap. That's about 20 dirhams per year for every 10,000 dirhams invested. And I'm projecting a CAGR of 12% per annum for this one because tech tends to outpace the broader market. Is it risky? Maybe. Am I young enough to handle that risk? You bet. I look at it like this. I'm not investing in Nvidia or Apple. I'm not even investing in tech-specific ETF like the VGT or SMH. It just so happens that the top companies in the US market at present are tech companies. If tech crashes, their share in the S&P 500 or NASDAQ 100 will drop and a company from another sector may take the throne. Risky to me means the collapse of the US market as a whole, which is a much more digestible risk. Personally. The next ETF I invest in is IWVI, iShares Edge MSCI World Value Factor. Yes, it's a mouthful, I know. My allocation in the ETF portfolio is 17.68% for this one, and my overall exposure in my portfolio to this ETF is about 8%. Here's where I get contrarian. While everyone's chasing growth stocks, I've got a chunk dedicated to value. This ETF focuses on undervalued companies across the developed markets. The boring stocks the Wall Street forgot about. Why value? Because as Benjamin Graham taught us, in a short run, the market is a voting machine. In the long run, it's a weighing machine. Eventually, value gets recognized. The expense ratio for this one is 0.25%. Again, very reasonable for a factor-based ETF. That's 25 dirhams annually per 10,000 dirhams invested. This is my hedge against the tech bubble popping. If growth stocks crater, value historically holds up better. I'm expecting 9% returns for this one, lower than growth stocks, but with less volatility. Plus, this gives me geographic diversification beyond just the US. We're talking Europe, Japan, Australia, true global exposure. And that brings us to WSML, the iShares MSCI World Small Cap. This forms 17.68% of my ETF portfolio and about 8% of my overall portfolio. Small caps, the baby companies that could become tomorrow's giants or tomorrow's bankruptcy filings as well. It's like venture capital, except you're buying public companies. So at least there is some accountability. Sort of. The expense ratio is on the higher side at 0.35%, but that's typical for small cap exposure. You're paying for access to companies that are harder and more expensive to trade. Historically, small caps outperform large caps over long periods. They're volatile, sure. I've got 20 to 30 years before retirement, so I think I can handle the roller coaster. Actually, I kind of enjoy it. Is that weird? My projected returns, 12% CAGR. Is that aggressive? Maybe. Small caps have delivered these returns historically, and I'm betting on mean reversion. We then have XUS, the X-Trackers MSCI World XUSA, which basically excludes US. The internal allocation in my ETF section is 14.65%, which forms about 6.67% of my overall portfolio. About 55 to 60% of my equity portfolio is US focused because a part of world value and world small cap also have some US exposure that is on top of my CSPX and Nasdaq 100 ETFs. So ex-US is my deliberate effort to diversify away from American exceptionalism. This ETF gives me access to developed markets excluding the USA, Europe, Japan, UK, Canada, all the market that might surprise us when the US stumbles. The expense ratio is just 0.15%, which is excellent value. The expected returns, 9%. Lower than the US, but that's fine. This is insurance, not a lottery ticket. Then we have EIMI, which is the iShares Core MSCI Emerging Markets Fund. This forms 12.12% of my ETF portfolio and about 5.52% of my overall portfolio. Emerging markets, China, India, yes, separate from my Indian mutual funds, and it also includes markets like Brazil, Taiwan, the growth engines of the future. EIMI's exposure to Indian companies specifically may be a small portion of this 5.52% allocation, which is one of the reasons I invest in the Indian mutual funds separately, bringing my overall exposure to the Indian market to about 7 to 8% of my portfolio. This ETF includes small and mid-cap companies in emerging markets, not just the large caps. It's a broader exposure than most emerging market funds, and the IMI stands for Investable Market Index, which basically means it captures about 99% of the available market in emerging economies. The expense ratio is 0.18%, incredibly cheap for emerging markets exposure. Most EM funds charge about 0.4% or more. Expected returns only 8%, the lowest of my equity ETFs. Why? Because emerging markets are unpredictable. Political risk, currency risk, liquidity risk. It's all there, but so is the potential for explosive growth. I'm keeping this at about 12% of my ETF allocation because I don't want to bet the farm on unstable economies, but I also don't want to miss out if these markets finally deliver on their promise. And finally, we have IWSZ, the placeholder. You might notice IWSZ listed with 0% allocation. This is the iShares MSCI World Mid-Cap Equal Weight Fund. I'm considering it for future investments if my disposable income increases significantly. Why not now? Because mid-caps would add another layer of diversification, but I don't want to spread myself too thin. As Buffett once said, diversification is protection against ignorance. I'd rather master what I have before adding more complexity. Okay, let's discuss the elephant in the room. There is definitely overlap between some of these ETFs. CSPX and XNAS, they both hold Apple, Microsoft, Nvidia, Amazon, and Google. In fact, about 50 to 60 of the top Nasdaq 100 companies are also in the S&P 500. The Magnificent 7 tech stocks, they are in both. So yeah, when I buy both, I'm essentially doubling down on big tech. My WSML, which is a small cap ETF, and the IWVI, which is the value ETF, have minimal overlap with each other and with the large cap indices. That's by design. They're capturing different market segments. EIMI and my India mutual funds, there's definitely some overlap on the India side. Maybe 10 to 15% of EIMI is India stocks, and I'm adding another 6% pure India exposure through mutual funds. Am I overweight India? Probably. Do I think India's growth story justifies it? Absolutely. Is this inefficient? Maybe. Am I losing sleep over it? Definitely not. Here's why. The Nasdaq position is an international overweight on tech. I'm not just diversifying for the sake of diversification. I'm expressing a view. I think technology will continue to dominate returns, so I want more exposure to it, not less. Think of it this way. If you really love pepperoni pizza, you could order just one large pepperoni, or you could get a medium super supreme that has some pepperoni in it, plus a small pepperoni just for that sweet focus on pepperoni. Yes, it's a little more work, what with the extra box and all, but to me, it's worth it. Look, I know it's not the best analogy in the world, but there's no need to yell at me in the comments. But you get the idea. Apparently, if you're me, the answer is the medium plus the small. Look, nobody's perfect, okay? Could I achieve a similar result with a single world ETF plus an S&P 500 ETF? Sure. But I just love doing the research and allocating exactly what I want, where I want. The overlap isn't a bug. It's a feature. It's my way of tilting towards what I believe in while still maintaining broad market exposure. Now, is this right for everyone? Absolutely not. If you're buying your first ETF, just buy a CSPX or a total world fund and call it a day. This level of complexity is only justified at higher portfolio sizes where the percentages actually matter. Which brings me to a quick ETF explainer. For those new to this, let me quickly explain what an ETF even is. ETF stands for Exchange Traded Funds. Think of it as a basket of stocks that trades like a single stock. Instead of buying Apple, Microsoft, and 498 other companies individually, you buy one share of CSPX and instantly own a piece of all 500 companies. Expense ratio is what the fund charges annually to manage your money. My ETF range from 0.07% to 0.35%, which is incredibly low. For context, traditional mutual funds in India often charge 1 to 2% per annum, eating into your return. Here's a quick comparison of what I'm paying across all of my portfolio. CSPX is the cheapest at 0.07%, ex-US is 0.15%, EIMI is at 0.18%, ex-NAS is at 0.2%, IWVI is at 0.25%, WSML is at 0.35%, the Axis Small Cap is at 0.55%, HDFC Flexi Cap is at 0.7%, the ICICI Value Fund, which is my most expensive, is at 1.5%. Why does this matter? On a 10,000 dirham investment, the difference between 0.07 and 1.5% is about 143 dirhams per year. Over 30 years with compounding, that small difference becomes massive. UCITS means these funds comply with European regulations, making them accessible to us in the UAE without complex tax implications. All of my ETF investments that we've discussed so far are Irish domiciled UCITS. The other matter is accumulating versus distributing. Accumulating funds automatically reinvest dividends. Distributing funds pay them out as cash. For long-term wealth building, accumulating is usually better. Got it? Cool. Moving on. Now let's talk about my India bet. 6% might seem small, but remember, I already have indirect India exposure through EIMI. This is pure concentrated rupee denominated Indian equity. Why India? Demographic dividend, digitalization and reforms. India is where China was 15 years ago. And I want to ride that wave. Plus, it's nice to have some skin in the game of the country that gave us our culture and our way of life. But here's the thing, I'm not going all in. This is a satellite position, not core holdings. India has massive potential, but also massive risk, political drama, infrastructure challenges, and the fact that Indian markets can be more volatile than a pressure cooker ready to explode. Not to mention currency risks. I've split my Indian mutual fund portfolio equally across 4 mutual funds. The first one is ICICI Prudential Value Fund, looking for undervalued Indian companies. This fund has an expense ratio of 1.5% for the direct plan, which is fairly typical for actively managed Indian mutual funds. The second one is the ICICI Prudential Large and Mid Cap Fund. Balanced exposure to established and emerging players, giving me both stability and growth potential from India's mid cap story. The next one is the Axis Small Cap Fund. It's high risk, high reward Indian small caps. This one has an expense ratio of about 0.55% to 0.56%, which is actually quite competitive. Small caps in India have historically delivered explosive returns, though with significant volatility. My last holding in the Indian mutual fund market is the HDFC Flexi Cap Fund. This fund can invest across all market caps based on opportunities. The fund manager has the flexibility to move between large, mid and small caps depending on where they see value. The expense ratio for this is around 0.7%. Each of these mutual funds gets 25% of the Indian allocation or 1.51% of my total portfolio allocation. Expected returns across all, I've projected 12% CAGR, ambitious but achievable given India's historical performance and these funds' track records. For context, Axis Small Cap has delivered an annualized return of around 28% over the past 5 years, while HDFC Flexi Cap has also been in the 28 to 30% range. Of course, past performance does not guarantee future returns, but it shows the potential. Why these specific funds? Proven track records, experienced fund managers, and reasonable expense ratios by Indian standards. Yes, they're higher than my ETFs. We're talking 0.55 to 1.5 versus 0.07 to 0.37. But that's the cost of active management in emerging markets. The risk here is currency volatility, regulatory changes, and market-specific crashes. But at just 6% of my portfolio, even if India disappointed completely, it wouldn't derail my financial plan. And now the part that might get me roasted in the comments. Nearly half my portfolio at 48.42% is in cash-like instruments. Let me explain why this isn't as crazy as it sounds. First, I have national bonds at about 12%. This is a UAE savings scheme that offers around 4% returns annually. It's liquid, it's government backed, and it gives me peace of mind. Is 4% going to make me rich? No. But the million dirham draws might. And now the big one. Over a third of my portfolio is in Mashrak Neo, currently earning around 6.25% per annum. I hear you screaming, bro, cash is trash. You're losing to inflation. What kind of financial YouTuber are you? Listen, I get it. Every finance bro on the internet will tell you that cash is for losers, that you should be 100% in equities, that time in the market beats timing the market, which means you should never ever hold cash. Maybe, but here's my thinking for both Mashrak and national bonds. And this is where I might be completely wrong. So by all means, feel free to roast me in the comments if you disagree. The first point is market crash capital. When the markets drop 30 to 40%, I want to have some cash ready to deploy. This happened in 2000, it happened in 2008, it happened in March 2020, and it's happened many other times in our history as well. Markets crashed and people with cash made fortunes buying the dip. It happened in 2022 when everything was on sale, and it will happen again. I don't know when, but it will. And when everyone else is forced to sell because they need liquidity, I want to be the guy buying. The second reason I have this is for real estate down payment. I'm actively looking at property investments in the UAE. Real estate here moves fast. When the right deals appear, and I mean significantly below market value, not just seems okay, I need to move within days, sometimes hours. When that opportunity does come up, you can't really wait 3 to 5 business days to liquidate that ETF or be in a position where you have to liquidate that ETF when the market is actually down, when that villa hits the market at 200,000 below valuation because the seller needs to relocate urgently. The third reason is the unsexy truth. Knowing that I have 36% of my portfolio in liquid, accessible cash in just my savings account lets me sleep soundly even when my ETFs are down 20%. Brother, During the 2022 bear market, I didn't panic sell because I knew I had liquid reserves. I was ready to deploy. That psychological benefit, it's worth the opportunity cost for me. The other thing is opportunity cost isn't just returns. Yes, this cash could be in the market earning 8 to 10%, but the opportunity cost of not having cash when opportunities arise is even higher. Missing out on a 30% market dip because you're fully invested, that is massive opportunity cost. Look, I want to emphasize that this allocation is where my money goes automatically every month after the paycheck hits the account. This portfolio conservatively nets me 8% per annum as a whole, including the cash, over the long term. If I invest just over 7,000 dirhams per month like clockwork till my retirement with this allocation, cash in Mashrak or not, I'd have almost 3 million. That's in USD. The gravy on top is that I can also then use the cash for other options I just mentioned. As Ray Dalio says, cash is trash until everything else is on sale. Then suddenly cash is king. I'd rather have slightly lower returns with the ability to be opportunistic than maximize every percent and watch opportunities pass by. Will I always keep 36% in cash? Probably not. As markets correct or as real estate opportunities materialize, this will shrink. But for now, it's my strategic reserve. Alright, let's talk about something practical because I know that some of you are thinking right now, this looks great, dude, but I only have 500 dirhams or 1000 dirhams per month to invest. Does this strategy work for me? The short answer, not really. Everyone who tells you otherwise is either lying or trying to sell you something. Let's do the math. If you're investing 500 dirhams a month and you try to copy my allocation, 45.53% is allocated to ETFs. But within that, we have 6 ETFs. That would mean you're splitting that 227 dirhams into 6 different ETFs, which would roughly be 38 dirhams each. 6% to Indian mutual funds, that's roughly 7.5 dirhams per mutual fund. And the balance 48.42% in cash, that would only amount to 252 dirhams per month. Here's my problem, and it's a big one. Each ETF purchased through brokers might cost you varying amounts depending on the platform. If you're buying 38 dirhams worth of an ETF and paying significant fees, you're losing a huge chunk to transaction costs. That's not investing. That's just donating money to your broker. If you have 500 to 3000 dirhams monthly, pick one broad global ETF. Could be CSPX or a total world fund like VWC. Put 60 to 70% there through monthly dollar cost averaging and keep the balance in cash savings. That could be your Mashrak account or national bonds or any other account of your choice. Use Sarva or Interactive Brokers. Both have their pros and cons, and I use both. I'll link them below if you want to check them out. Revisit this strategy when you hit 5,000 plus monthly investable income. Don't feel bad about keeping it simple. Simplicity is actually a competitive advantage. Focus on consistency over complexity. If you have 5,000 to 10,000 dirhams monthly, maybe split them between 2 to 3 ETFs max. One US focused, one international, one maybe emerging markets. Start adding the India allocation if you believe in the story. Build your cash reserves to 3 to 6 months of expenses. You can start to diversify a bit more without getting killed by fees. If you have 20,000 dirhams or more monthly, now this allocation makes more sense. The fees become negligible percentages, 1 to 2% instead of 40%. You can meaningfully diversify across multiple positions. Each position can actually move the needle on your portfolio. Complexity scales with capital. Start simple, add layers as you grow. Don't try to have a 12 position portfolio when you're investing 1000 dirhams a month. That's like trying to drive a Formula 1 car when you just have a learner's permit. A quick minute on a boring but important word: rebalancing. I'm not getting deep into this today because honestly, it's about as exciting as watching paint dry. But here's the principle. Over time, your winners will outgrow your losers. If tech does well, suddenly XNAS might be 25% instead of 20% of your portfolio. If India disappoints, maybe it drops to 4% instead of 6%. At some point, maybe annually, maybe when things drift more than 5% from target, you might want to rebalance. Sell a bit of what's grown, buy what's lagged. Or the easier way, just adjust your new contribution to buy more of what's underweight. As Dr. Burton Malkiel once said, a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. But even that monkey would need to rebalance occasionally. For most of you, don't overthink this. Once a year is plenty. Set a calendar reminder, have a coffee, look at your allocations, make adjustments if needed. Then forget about it for another year. Alright, before we get into the risks of my portfolio structure, let me give you the full portfolio summary at a glance because I know some of you are visual learners. My global ETFs, which is 45.53 of my total portfolio, consists of CSPX, which is 8% of my portfolio, that is expected to net me 10% per annum. XNAS, which is 9.2% of my portfolio, which is expected to net me 12% per annum. IWVI is expected to net me 9%, and that is 8% of my portfolio. WSML is also 8% of my portfolio, which is going to net me 12% of expected returns. XUS is 6.67% of my portfolio, expected to net me 9% ROI. EIMI, which is the Emerging Markets Fund, is expected to do 8% of CAGR, and that is 5.52% of my portfolio. The Indian mutual funds, each of which is at 1.51% of my total portfolio, is invested in the ICICI Prudential Value Fund, the ICICI Large and Mid Cap Fund, the Axis Small Cap Fund, and the HDFC Flexi Cap Fund. Each of these are expected to net me 12% per annum in CAGR. And then we have the cash and liquid assets, which is 48.42% of my portfolio, out of which 12% is allocated to national bonds, which would net me 4% per annum, assuming I don't win anything, which is the right way to do it. And 36.31% of my portfolio is earning me 6.25% per annum in Mashruq Neo. The weighted overall expected portfolio return is around 8% per annum, that is including the returns on the cash. If I were 100% in equities, my expected return would be around 10 to 11%, but with the cash buffer, I'm trading some return for optionality and peace of mind. Now let's get real about the risks in my portfolio. Over concentration in cash is definitely one of the risks. If we hit a decade-long bull run, I'm leaving serious money on the table. That's 36% of my portfolio that could compound to much more in equities. But as I said, even with the opportunity cost, I'm content with my financial plan to get me to my goals. Greed is the killer that destroys many. Nice. The second risk is the tech concentration. My portfolio is tech heavy between CSPX and XNAS. If tech crashes like 2000, I'm going to feel it. But my overall portfolio should stabilize over the long time frame. So I'm not too worried about it. As I said, my investment time frame is 20 to 30 years, and that is a huge factor that needs to be considered. Third risk is that the India bet might not pay off. 6% in a single country is a gamble. Political instability, currency crisis, or just underperformance could hurt. What if India's growth story turns out to be overhyped? What if the rupee weakens significantly against the dirham? What if those sky-high valuations in Indian small caps come crashing down? All legitimate concerns. But at 6% of my portfolio, even if India goes to zero, which it won't, I'd survive. It would sting, but it won't devastate me. And the last risk is that there is no dividend income. Everything is accumulating. If I needed some income today, I'd have to sell assets. Not ideal for everyone, but then again, this is where the huge cash pile comes in. Now, you might consider one other risk, which could be that the UAE banking concentration in Mashruq is great until it isn't. There's no FDIC here, but in general, as a bank that is governed by the central bank in UAE, banks in UAE are generally considered safe overall. Diversifying banks would be smarter. This is why I park some of my funds in national bonds. But yes, I recognize that once the balance hits a certain threshold, I may have to open accounts with other banks as well. Am I losing sleep over these risks? Absolutely not. But I am aware of them and I am monitoring them. Look, here's the bottom line. This portfolio isn't perfect. It's not the optimal, efficient frontier that finance professors would design. If I showed this To a CFP, they'd probably have 17 different suggestions for improvement. But it's mine. It reflects my beliefs, my timeline, my risk tolerance, and my goals. It reflects my belief that India will surprise people. It reflects my desire to have cash ready for opportunities. It reflects my comfort with complexity. My being the keyword. This is the reason my last video was about how you can design your perfect portfolio, including all the variables that you need to consider while designing it. And most importantly, it reflects what I can stick with when things get tough. The best portfolio isn't the one with the highest returns. It's the one that you can stick with through market crashes, personal doubts, and economic uncertainty. It's the one that doesn't make you panic sell at the bottom. It's the one that lets you sleep at night. As Peter Lynch once said, the real key to making money in stocks is not to get scared out of them. Having that cash cushion, that's what keeps me from getting scared. Diversifying globally, that's what lets me sleep at night. Betting on India, that's my personal conviction playing out. Overweighing tech, that's my view on where the world is going. Your portfolio should be different because you are different. Personal finance is personal. If you're 25 with no dependents, you probably should have way more equity exposure and way less cash. If you're 50 with kids in college, maybe more bonds, dividend ETFs, and stability is for you. If you hate tech, skip the Nasdaq, go S&P 500 or go heavy on value instead. If you love real estate, allocate there instead of Mashreq Neo. If you think India is overvalued, skip those mutual funds and add more emerging markets elsewhere. The only rules that matter: start investing early. As someone said, maybe it was Warren Buffett, I don't remember, the best time to invest was yesterday, but the second best time to invest is today. Next, keep costs low. Every percent matters. Diversify across assets and geographies. Don't bet the farm on one thing. Don't panic sell. Review annually, not daily. Checking your portfolio every day is a recipe for bad decisions. That's it. Everything else is details. So that is my portfolio in all its transparent glory. If you made it this far, you're the real GOAT. Drop a comment letting me know what would you change about this allocation. Be brutal. I can take it. Am I completely insane in keeping almost half of my portfolio in cash? Also comment and ask me if you have any questions. Seriously, anything. I'll try to answer as many as I can. And hey, if this helped you think differently about your own portfolio, smash that like button. But if you think I'm completely wrong, you know what? Still smash that like button, but let me know why down below. Don't forget to subscribe if you want more NRI specific financial content. We are building a community here where we can all learn together. Here's a video that shows you how to create your portfolio, or watch this for 9 expenses that you seriously need to consider as an NRI living in UAE. Yalla Arbab. Remember, it doesn't matter if you can only invest $5 a month or 50K a month. Give yourself a pat on the back for being here today to learn and boss your money tomorrow. I'll catch you in the next one. Take care.